We're rolling on the tube.
We're rolling on everything. Everything.
Everybody in the club getting tipsy.
Everything. Okay, we're here to answer all your mortgage questions every single day, Monday through Friday, 11:30 a.m. to 12:30 p.m. Pacific time. So where you're at across the country, adjust those time slots. Make sure you're here to load up the chat box with all the questions that you may have about buying a house.
That is so specific.
We are in Pacific.
I thought you said specific.
We are in Pacific. We are in California, which is Pacific time. That being said, you got questions about down payment, closing costs, what it takes to buy a house, what credit do you need, how much can I afford, what programs do you have, can you build a house, can you buy a manufactured house, can you buy a condo, blah, 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 blah.
Boxers or briefs?
We have all the questions. He wants to know if you wear boxers or briefs. I don't care. Okay, what do we got here? We got Ginger Sparks already in the house. Ginger Sparks, are you famous? How does buying a foreclosure home work?
Texas. LOA.
Texas I think it says loans.
All right, cool. How does buying a
Loan officer.
Ginger,
welcome.
The lender. Hey, we start out with LOs. Ginger, we appreciate you being here. We always do. We're two licensed loan officers out of California. We do business in all 50 states. We do try and help loan officers. We've been doing it a very long time. So, how does buying a foreclosure work? Depends on what phase of the foreclosure you're in. Because at foreclosure, if the bank actually takes it, it becomes what's called an REO. REO is real estate owned by a bank. When it's real estate owned by a bank, the bank has a REO realtor that they contract with, and that they'll say, hey, listen, I'll give you 20 foreclosures. But the realtor now has to put it on the market. Here's the difference. You're dealing with the bank. You're not dealing with a person. So there's not really emotions involved. The bank is running numbers. If you're thinking that you're going to get a dramatically, unbelievably great deal, that's usually not what happens. Usually not. The reason is, if somebody got foreclosed on, somebody took their house. I mean, and they didn't take it. There's a cash for keys or voluntary foreclosure. That's when they're like, hey, here's my house. And I don't want you to hurt my credit too bad. And it actually goes in the credit system as voluntary foreclosure. But if they foreclosed, they waited 3 months till they filed a notice of default. Then they probably waited another 3 to 6 to 9 months before the sheriff stepped in and said, hey, y'all are leaving. And they were mad. They were not happy about it. And we've heard some horror stories about people pouring concrete down the drains because it hardens and then you can't get it out. So you have to literally open all that stuff up, tear the wiring out of the walls. While they're in the house, they can do damage to it. And they don't care because they're about to lose it. So what happens is the bank takes it and they're like, shit, we got to fix this thing. So they spend money fixing it. And then they have to deal with the market. What's the market? If the market's $500,000, they say, okay, cool. We got a house that's worth $500,000. We're not in the business of making a profit. We just want to get this off our books. So they'll talk to the real estate agent that they contracted, and the real estate agent will go, hey, listen, I can sell this within 20 days for $490,000. So there's a little bit cheaper, and the bank just runs numbers. It just runs numbers. So that's that version. So there's another version where somebody's currently in foreclosure, and they do not want it to fully execute foreclosure. In that case, you might be able to get a deal, but it's just a standard transaction. It's not really, really complicated. It's just somebody's in distress. The other version is REO, which is real estate owned by bank. And people think you get a bang up deal when you do this. You can get sometimes an okay deal, but sometimes you don't know what you're getting. That's the reality of it.
And that's probably a big piece, because when you go in to buy a house and you put in an offer, an appraiser comes out and says, we need to repair this, and that. And then the bank's not going to do it. They're going to go, no, we just want to sell the house as is. Find a buyer that can buy it as is. They're not going to give you money back. They're not going to credit you. They're not going to do repairs in most cases. Not every case, just most cases. So they can be challenging. Osvaldo, loan officer, got my escrowed waived with only 3% down.
I don't know what that means.
Me either.
Yeah, that's hard because there's two versions of escrow. Part escrow is when you enter the contract. You got the seller and the buyer, and then the non-biased third party, which is escrow. And they just make sure that everybody executes what they're supposed to. That's escrow. what a lot of people think escrow is the impound account, and it can be called that. So there's an impound account that pays for your property taxes and insurance. So when you say I got escrow waived, did you get the non-biased third party that makes sure that everybody executes waived? Because I've never heard that before. Or did you get the impound account waived, which is an option in certain loans that you can do, but that doesn't mean you don't have to pay it. It just means that it's not built into the payment.
Yeah. Let's see. Andrew. Nope. Alex Behar. Thoughts on buying at max of what you were pre-approved for?
Alex, so it's going to depend. If you're barely making it, and you're like one flat tire away from financial decisions for your family, I don't recommend you pushing the red line. I really do not. It's because you can really hurt yourself. And the banks actually have a system that's, you can't. They kind of don't let you get the loan where you hurt yourself. However, if you're making $100,000 a year or $200,000 a year and it's very uncomfortable because you don't want to eat low-end meat instead of prime rib, that's not such a bad overall scenario because you're not really pushing yourself to the end.
And in most cases, people are like, "Hey, I'm approved for $330,000. Can you get me to $340,000?"
Yeah, it's almost always people are pushing beyond the limit. Very rare is it that I find somebody who says, "Hey, you know what? I want to buy reasonably," and that's only because of the market. It's not because of the people. It's not because of all those things. It's because of the market. The market, it's a high interest rate. It's really, really difficult to get a house right now.
Yeah. Osvaldo said his impound account he meant. So he got a loan at 3% with no impound account?
Okay, so Osvaldo, impound account is a part of the mortgage payment where they actually bring in your property taxes and your insurance, because your property taxes are due twice a year. So they're due on this date, but instead of you getting a $5,000 bill every 6 months, the mortgage company will put in, I don't know, maybe a $600 extra payment, and that's called an impound account. Also, your insurance. Your insurance is paid yearly, even though it appears it's paid monthly. It's paid yearly because it's cheaper. So what they do is they say, hey, listen, for your insurance, it's $100 a month. So we're going to take $100 a month, and then we'll pay the insurance company $1,200 on that yearly date. Whether you have it or not, they pay it, and then they catch up through the impound account. Now, you do have the ability to waive that impound account. You have the ability to waive it. It does cost you an interest rate. Maybe your loan officer told you that. Maybe they didn't. But it's more expensive if you waive the impound account. Why? Because you increase the risk to the bank. If you don't pay your property taxes, the only lien that is superior to the mortgage is a tax lien. So that goes above the mortgage, and the bank kind of doesn't want that. They don't forbid it, but they do hit you with the higher interest rate in order to make that happen. So it's not uncommon, and it's not really a win unless you want to pay for it yourself. I did it once. I will never do it again. I've had many mortgages. I did it once, and then every 6 months I had to write a check, and then the insurance company, and all this crap that the bank takes care of already, and my interest rate was just a touch higher, and when I reverse engineered it, that was stupid for me to do it. So, yeah.
I'm going to say it is uncommon. It is uncommon at 3% down. That's first-time home buyer program, which means he used either Home Ready or Home Possible.
Yeah.
And they don't allow you to not have that impound account. You need to put more money down in order to show that you can pass that test. Okay. So they're a little interesting, but if you did it, you did it. Congratulations. Shauna Ramirez had a Chapter 7 6 years ago and didn't reaffirm house. Up to date on payments. Can I do a HELOC?
Heck no. Sorry, didn't mean to be so rude on that one and crude, but no. So, Shauna, let me tell you what happened. Here's what happened. You said if you did a Chapter 7, Chapter 7 is, I'm not paying any of this crap. I know I bought the car, I bought the wave runners, I bought the boat. Hey, I'm just not paying it. Screw you all. The system has to take it. That's what happened. And inside of that, there's the mortgage. But here's the problem with the mortgage. The problem is that I still want to live in that house because I really like that house. I may lose the wave runner, I may lose everything else, but I don't want to lose the house. So when the bankruptcy attorney fires all this stuff, he says, hey, Your Honor, all of it. And Your Honor says, Okay, I'll put it all in the pile. And the attorney will tell you, hey, listen, in order to put your house back on the credit, you have to reaffirm the house. What's the downside of that? Well, there's no real downside, no real upside. If as long as you're making the payments, the bank's probably not going to foreclose. Probably not going to foreclose. Where you're like, hey, I'd sure like that option of not having the liability, so why reaffirm it? And you don't. And then life gets better. And then all of a sudden, hey, I don't have all that debt before. My income is good now because I didn't have to make those payments. My credit score went up because all those things disappeared. You know what? Time for me to get HELOC. And you go, hey, I've been making these payments on time. We pull credit, we don't see it. But honest, bro, I've been making the payments. We don't see it. But that's not fair. Yeah, it's how it works. You have to reaffirm the mortgage, then the mortgage payment have to show. Now, there was a time when you could do a VOM, which is a verification of mortgage, and you might be able to do a HELOC. But right now, no, not happening. So you got to reaffirm it. Then we got to have a history of the payments. I know you've probably been paying it on time for the last 2, 3, 5, 10 years, whatever. But if it's not showing on the credit report and you haven't reaffirmed it, no HELOC.
Andrew Moretto, can I exclude my car payment that my girlfriend pays, but it's in my name for a home loan? You need to write a book, Andrew. Just like Iceberg Slim and how to get women to pay your bills. That's actually pretty cool. Much respect.
Dude, I'll read it.
Much respect.
I will read it right now. I will pause this live to read that book so I can get my girl to pay my payment. Okay, so here's the rule on that. If somebody else has been making the payment and they are on the note, and they've been making the payment for 12 months out of their account, not that they've been giving you the money and it went to your account. Can't do it that way. But if they've been making the payment out of their account for 12 months and it's never been late, we can exclude it.
Yeah, let us know when that book hits Amazon, man.
Yeah.
Ginger Sparks told Alex, don't do this, not unless you have extra cash flow that was not accounted for. Now, here's the thing, guys. When you're buying a house, it's not like buying a car. You can really bury yourself with the car and a mortgage, depending on how you look at it. But the bank has a limit. The bank says, hey, we're not going past this limit because you still need to pay taxes, buy food, put gas in your car, take care of your kids, blah, 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 blah. Cars are different. Cars let you go as high as you possibly
you
want.
can go crazy on cars.
Yeah, you can make $1,500 a month and have a $1,000 car payment.
We know guys that are driving Lamborghinis that should not be driving Lamborghinis.
I don't know if they drive them anymore.
They don't drive them anymore.
Can't afford the gas.
Insurance is too expensive.
But a house, there's limits, okay? If you hit that limit, it could be expensive. It can be tight, but it's not going to necessarily bury you. You might not be able to go to Starbucks. You might not be able to go to the movies, but you can make your mortgage payment.
Ginger, you're the new LO, so here's something that you should know. You probably went through LO school, and when you went through LO school, they told you that Fannie Mae and Freddie Mac, front end 35% DTI, back end 43. You could take that, pass the test. Congratulations, you're a loan officer. Now throw that shit away, because that never happens.
Welcome to reality.
Yeah, you're going to be in 40, 50 on a Fannie Mae Freddie Mac and 45, 55, 56.999 on an FHA.
Unless your buyers are all rich, and that's a different case.
Maybe if you have rich buyers. Yeah. I want to go work for you if that's the case.
Shauna,
can I go work for you?
Call us. Okay, 175 income payments up to date. That's the reaffirm one. Yeah, it's still going to be a challenge. Yep. I'm not going to say that it's an absolute no, because there are a lot of different HELOC companies out there. A lot of HELOC companies out there.
You could go Alt QM, but you can't go conventional conforming, which is Fannie Mae, Freddie Mac, VA, FHA, and USDA. You can't do those.
Group Home Pro bought a house on FHA 2.75 in 2020. Great job. I want to get rid of PMI, but they're telling me I have to pay it off in full.
Yeah.
It's a refi.
Yeah. So, first off, Group Home Pro, like the name, that means you're a pro at group homes. 2.75. That's a hell of a rate.
Hell of a rate.
Hell of a rate. Let me teach you how to mentally adjust to this, okay? You're not going to get rid of that PMI. It's mandatory. And unless you put more than 10% down, it will be for the life of the loan. If you put more than 10% down, it'll go away in 11 years. But if you put less, if you put 3.5% down, then you have 2.75% rate. But I'm going to teach you how to live with this mentally, okay? Because there's a 0.55 on your FHA. So you take 2.75 and you add 0.55. So your net effective interest rate is 3.3. That's the new number I want you to mentally adjust to. 3.3.
Well, 2020 is 0.85.
0.85?
2020?
2020? Might be. Yeah, so maybe 3.40, probably 3.40. So you're still in at a net effective rate at 3.40. I got to check the math on that because he messed me up with the 0.85.
Stupid facts.
0.55. Yeah, stupid facts. So your new net effective rate is the number that you need to know, because here's what people do. They're like, hey, I have 2.75 with MI. Yeah, MI is mandatory on an FHA, and then all it does is change your net effective interest rate. That's it. So you have a new net effective interest rate, and when you can get lower than that, it's a good idea to refinance. But at that low level, probably not happening for about 4 or 5 years from now. So you're in a good spot. That's a really, really good spot. Everybody would like to get rid of PMI. Everybody. But it's just math. You can call it PMI, you can call it MI, you can call it mortgage rate, you can call it interest, APR, whatever you want to call it, is just math.
Ooh. Alex again, thoughts on waiving appraisal contingency to compete for a house?
If you really know what you're doing, maybe.
Strong agent.
Maybe.
Hope you have a strong agent.
Yeah, but have a strong agent, because here's the problem with appraisal waiver. Appraisal catches stuff. And appraisal will catch a bad roof. Appraisal will catch a foundation issue. Big stuff. Your home inspection should catch this also. But appraisal will give you real value. Real value. You actually know what the value is. However, if you're in a very competitive market and the listing agent is better than your buyer's agent, what?
Does that happen?
They'll know that there's no way in hell this house is going to appraise. There's no way in hell. So I'll accept your offer if you'll waive the appraisal part. What they're really doing is saying, hey, listen, yeah, this isn't going to work. And this does boil down to the skill of your realtors. However, here's a big however. If you're going to use a loan, Fannie Mae, Freddie Mac, VA, USDA, a few others, you're not going to be able to waive the appraisal unless you're putting a massive amount down. A big amount, 20% down. Because the bank wants to know what the value is. Even if you're willing to forget it, the bank's not. Agree?
Yeah, I agree. Let's go to Facebook. Jerry A. Cook in the house.
Jerry A. Cook. What's up, Jerry A. Cook?
Do renovation loans work for mobile homes affixed to 2.5 acres with septic, gas, electric? How do they determine ARV, North Texas location?
Whoa, that's a lot of math right there. That's a lot to unpack. So let's start with renovation loan. What is a renovation loan?
It's a loan that helps you renovate your house.
Yep. 203K is the most visible one, probably the most visible one. There's one for VA, but 203K loans usually ride on an FHA. So if the house is financeable by FHA, then probably you can get a 203K. Probably. If it's not financeable by FHA, probably you won't be able to get a rehab loan. And what makes it financeable? That's pretty simple. If it's a mobile home, it has to be affixed to a permanent foundation via 433 and an engineering cert and a few other things depending on location. Texas, there's a few other little things that you have to do. But if it's financeable by FHA, then it meets the guidelines for FHA. And once it meets the guidelines for all FHA, which would be 203K also. Thoughts?
Yeah. And how do they determine ARV? Well, initially they're going to go out and do an appraisal. And during that appraisal, they're going to give them a checklist of the work to be done. And then they're going to determine, right now it's worth $350. If all these boxes are checked, potentially $350. So then you get the equity and all that stuff to access the funds, blah, 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 blah. So I hope that helps Jerry A. Cook. What do we got here? We have Shauna. My bank says they just pulled 12 months worth of statements. Are they incorrect?
Shauna. We're talking what's called a VOM. That's verification of mortgage. And there's a back office system for it. But here's the problem.
Oh, that might be the key right there. They only owe $50K, but it's worth $650,000.
Yeah, you're probably not going with the conventional conforming, and depends on your bank. Your bank could be if there's a credit union, the credit union doesn't always use FHA, VA, Fannie Mae, Freddie Mac. It doesn't use the conventional loans. The credit union builds their own proprietary products, and they get to set their guidelines for their products. Now, HELOCs right now, they're very popular because cash out refis are not good right now. So HELOCs are very popular, but the rates are 9, 10, 11, 12. I've seen them as high as 15. So the banks have an incentive to do that. Now, if you're dealing with a bank that's not going to use FHA, Fannie Mae, Freddie Mac, because we all have to follow guidelines. They're guidelines. We don't get to choose. We don't get to pick and choose whichever guideline we want. All the banks, if you're going to do an FHA loan, we have to follow the FHA guideline. But if you have a local credit union or a local bank that is using its own money, then they get to set their own rules. So that is a possibility that can happen in that situation. So maybe.
Miss Jasmine, wait, so how can I show proof I can omit my mortgage if I'm renting it out? It's showing my taxes 2 years. There's no omit. You do not omit.
You don't omit. Well, you're talking about two different things. If you're talking about the ones where you did not reaffirm, is that the same person that wasn't reaffirmed? Oh, okay.
Let me double check. But you're not omitting the loan. You have to factor in what the loan is and the money that you're bringing in. So there is no omit. So the 2 years of taxes, if you filed it correctly, hopefully, cross your fingers, you're showing a positive income there, okay? Mm-hmm. So if you're renting the house for $1,000 a month, you brought in $12,000 and you did some write-offs, but you have $1,000 a month, a year, what would you call that? Net positive on your taxes, then yeah, you're fine. But what most people do is they use their rentals to write off all their income. So they received $12,000 a year in income, but now they have $24,000 of losses, negative $12,000 for the year, and that affects you negatively. So you're not going to omit it, you're going to wash it, and you're either going to go positive or negative.
Yeah, and by the way, if you're the one who was saying that you didn't reaffirm, credit report is way different than Schedule E. Schedule E is what you send to the IRS. You say, hey, I have this. The IRS does not pull your credit. They don't care. They know if you own it.
That's Shauna.
Okay.
Ooh, Ginger, for real. It's all AUS approved DTI. Hell yeah. Seeing 4.99 and 50 DTI now.
Yeah. Well, you can get all the way up. Ginger Sparks, in case you didn't know, you're a brand new loan officer. You can get up to 56.99 DUAE on an FHA. 56.99. Your front end will probably be maxed at what?
46,999.
46.99. And those are crazy numbers. Hey, let me give you another one, Shauna Sparks. Shauna Sparks?
Yeah.
Okay. Shauna Sparks.
Oh, no, Ginger Sparks.
Ginger Sparks. Ginger Sparks. I'm getting Shauna and Ginger mixed up. Don't
Ginger
do that.
Spice.
Don't do that.
Ginger Spice
so,
from Texas.
On a VA, I've gotten a DUAUS AE on a VA at 72% back end because VA does not have that same requirement. It's residual driven. So VA is residual driven. If you're brand new, get a mentor for VA because it's a very powerful loan, but can be misused if you don't know how to use it.
Hey guys, do us a favor, share this live, give us a bunch of hearts. We're trying to get more people in here. Load up that chat box. We're going to answer all your questions, but it's time for a commercial.
If you need a badass loan, call a badass loan officer. You can reach your badass loan officers, Chris and Lee, at New American Funding. You should call them on their private cell phones, but don't call them right now because they're live and they will not answer. However, after we're done with the live, we will answer and help you get your house in 2024. This will disappear in 5, 4, 3, 2, 1.
Boom. You're welcome, Shauna.
We're here for you. Yeah, group, follow the host. We appreciate
you for the love. Joseph Ambrosio, do Section 184 HUD loans require PMI and minimum? Yes, they're FHA. So that's the 184 is the tribal loan, right? That's what
you're asking about? Look at you. Damn, you know your stuff, man. He came ready. He ate.
I ate.
Oh, boy, ate.
He talks like an 8-year-old or 12-year-old. What age is talking like that? High school?
I think it's high school,
14,
but it's funny, man.
I ate, fools.
He straight ate, man.
Yeah, so it's going to follow the same guidelines basically as the FHA, but you do have to approve your tribe and blah, 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 blah. All that documentation. But Here's the challenge, guys. Let me share this with you. I know some of you are collecting some pretty fat checks, depending on what your tribe is doing. Some of them like local here. We have Morongo, San Manuel, Pachanga.
San Manuel. I had a 21-year-old come in with 18 grand a month
Raking
for life. I'm sitting there going, 18 grand a month.
Yeah.
Oh my God. You hurt yourself at 18 years old.
But here's the challenge. So 18 grand a month, that's a great income, fantastic income that they're getting from the casino. But they went out and they financed an Escalade. They financed, what's that badass truck? Raptor.
Yeah.
They financed a Benz.
Yes.
They got one for their girlfriend. And now they have $14,000 in monthly payments.
Yeah.
They're not buying a house.
Yeah.
They're not buying a house. So if that's your case, Joseph, please don't do all that financing. Get your house first and then have all the fun.
Mm-hmm.
Joanna,
follow the host. We appreciate you, Joanna.
PB Fit 96. This is awesome.
We appreciate you, PB Fit 96. Are you working out right now? I want to know. Are you doing push-ups? Are you doing like 50 push-ups right now? Because we're excited. We're motivated. I'm going to hit the gym because I saw you today.
He's going to hit it.
Yep.
Joseph, awesome.
Awesome. I think Joseph, we need to send you to spell school because you spelled awesome incorrectly, but we still love you, man.
But he probably makes bank, bro.
I probably makes bank. Like that guy Gronkowski. Did you see that roast? Oh my God. Of Tom
I've done
Brady?
real money.
That's hilarious. He got up there. He's like, y'all think I'm a dumb fuck. I hit people for a living. I guess I am.
I don't know how to read.
He was great. He was great, man. Gronkowski was amazing.
Good sport. Great sport. Yeah, I wish I'm just a descendant. All right, well, cool.
Okay, cool.
Hit up your cousins, man.
Yeah,
Have them help you out.
I got some bank, man.
Miss Jasmine, maybe not omit is the right word. My intent is for my first mortgage, not to count for me on my second. Yes. So here's how you do it, guys. Here's how you do it. Let's pretend for a second. Let's pretend.
We're going to go Wayne's World.
Do you guys know what Wayne's World is?
They probably don't. But Wayne's World.
But they know what that is.
Anyway, so you're now in fantasy land.
So you're in FHA. You have an FHA. You bought it a few years ago. You want to get your second home. You're going 5% down conventional. That's the key. You're going 5% conventional or more. You can put 20% down, 40% down. Doesn't matter. But a minimum of 5% conventional. Then you get yourself a renter. You lock them into contract. You say, you're going to get this house when I move out, but here's the contract. Sign it. Give me the deposit. Whatever the deposit is, 5 grand, 2 grand, whatever it is. Don't cash it yet. You don't have to cash it yet. Just have it. And then you can use that renter to offset that mortgage. So you're buying your new home. What was her name? You're buying your new home, Jasmine, as almost like a first-time home buyer, like you don't even have a mortgage.
Primary residence.
It's your primary residence.
3.5% down.
Not your investment property, your primary residence. Now, the second route, you filed your taxes. Like I told you before, you have to show at least zero out, par out at zero. If you go positive, we can use some of that income. If you go negative, that's counting against you. So now you're buying your first house again with less income.
1040X.
So there's 2 ways to do that. What he's talking about is you can actually reach back up to Iris and say, hey, Iris, I actually made a mistake on my taxes, and I want to do a little bit of a change on them. And you're going to file a 1040X, make some adjustments, pay a little bit of taxes, and then you can zero out that payment.
If you do a 1040X, though, the underwriters will scrutinize your file because they know what you did. They know what you did. They know. But it's not illegal. It's just they know what you did, and they really look at your file closely.
That's actually a really good thing to bring up.
What's that?
Because when you do that, you are going to say, hey, Iris, I'm making more money.
Iris is IRS, in case you didn't know that. He calls them Iris.
Here's some more money for taxes,
Yeah.
Iris.
Yeah.
So you think they're going to get upset at that? Not the IRS.
The IRS is going to be like, hey, you want to give me some money? I'll take it. I will love you for it.
And if I owe you it, I'll wait a year and then some to give it back.
Yeah, that's some.
Catherine, how long does it take to get an approval?
Catherine, depends on how motivated you are, Catherine. If you just sent in the documents and you sent them to us, and then you called us and said, hey, Chris Lee, I sent in all the documents, just want to make sure you got them. We'll go, okay, cool, let me open it up. Oh, you know what, we're missing the W-2. Send us the W-2s. Cool, I'll get them for you by the end of the day. Cool, perfect. All right, you'll probably get your approval within 24 to 40 hours, depending on your job. If you have a very difficult job, and let's say you own a business, you own 2 or 3 businesses, your income is all over the place, you have 1120s, K1s, it might take us some days to get the income calculated. But if you're straight W-2, you work for FedEx, and you make 80 grand a year, and you're straight, you've been doing that for 5 years, and you're real, I can do that. I can literally do it in a few hours. Now, we've actually had people from Alive call us and say, hey, listen, I'd like to place an offer on a house tonight. Highly motivated, good credit, good income. I have the down payment. How long will it take? And I said, if you are truly highly motivated, I will move all the files I have aside. If you get me the documents within the next hour, I will have you a pre-qual within 2 hours. Can you do that?
It's possible.
If they're highly motivated and we're really trying to do it, I can make it happen in 2 to 3 hours most of the time. But most people send in, hey, I sent you in 2022 1040, but I haven't gotten 2023 yet, and I don't have 2021. I don't have enough data. So you're not highly motivated. I move it to the side, and I wait till you get all the documents in. So it depends on how motivated you are, Catherine. If you wanted to really place an offer in tonight, 2 hours.
Yeah, and then here's very common, guys. This is very common. So if you go to the link in the bio, click on apply for a home loan now, you can start the process. But here's what happens to people. So right now, some of you heard this. Some of you are probably going to go in and do it, and you're probably sitting at your desk at work. And you're going to plug in the data, hit submit, get back to your job, and then forget about it. But there's no documents in there. You didn't upload paycheck stubs or W-2s or any of the necessary documentation that he's talking about, assuming you filled out the application, and now you're not getting any response because it hasn't told us that the application's done.
Yeah.
So here's what I'm going to recommend. If any of you have filled out an application and you think you're done, just text us.
Yeah,
just text us.
us,
I'll dig
call us,
in.
yeah.
I'll let you know what you're missing.
Yeah.
We'll start the conversation. We'll start the process. We'll pull the credit. But Catherine, he is absolutely right. If you're motivated, we're motivated. If you're not motivated, not much we can do.
Yeah, we don't use the trust me, bro, I make that kind of money concept. There's some loan officers like, just trust me, bro. I make 90 grand a year. Just trust me, bro. Trust me, bro.
Can I have the approval now?
Trust, bro.
Where's my approval?
Where's the trust? Where's the love? No, I actually have to calculate your income. And if you have a business or even a side business, I have to calculate the income or losses from the business. Anything that is shown to the IRS, I have to calculate it in order to make it work.
Jordan G, how much money is the limit for down payment assistance just for an FHA loan 30-year fix? I'm going to assume money is income.
Well, money is income, but it also could be how much purchase price.
Jordan, we got to clarify that
question.
Yeah,
because let's just talk about it from two different ways. So if you're in LA County, I think the limit is $188,000 a year. If you make over 188, you think so? 188?
That's for most programs.
AMI.
Most programs.
$188,000 a year. If you make more than $188,000 a year, the system says, "Hey, come on, man, come on, seriously."
That's very Joe
Biden
of you.
You make $188,000 a year and you want assistance? Come on, cut your crap. Cut your crap. And I even tell the people like, "Hey, I make $230,000 a year. Can I get a down payment assistance program?" I literally go, You make $230,000 a year and you want to use the program that's for people who can't afford the down payment? Come on, man. Seriously, they'll laugh and they'll go, "All right, Lee, I guess you're right." They actually have a limit. It's $188,000 a year. Now, if you're asking what the purchase price is, well, in LA, FHA max is what? FHA max?
Max what?
1 unit. Purchase price, 1 unit?
Million.
1.1, right? 1.1.
1.1.
It's 1.1 million for a 1 unit, but that's not the max. I'm going to guess on this one. I think it's a 4 unit, 1.8. So 1.8 million, and you can still use a down payment assistance program that's meant for people that don't have the money to buy a house. So they're pretty high, but the ratios are important, and most important, where everybody dies, Jordan G., FICO. If you have a okay FICO, not happening. If you really have a good FICO, like 750 or 800, maybe. But then AMIs kick in. What's AMI?
Area median income.
188,000 in LA County. I have seen it all the way down to 76,000 in Kentucky. I did one in Kentucky not that long ago. 76,000 was the AMI over there.
You're giving me Joey Biden vibes right now.
Joey Biden? Jeesh. All right, cool.
All right, Ginger back in the house.
What's up, Ginger?
How do people use money in 401k and stocks for their down payment?
Ginger, Sparks, Texas, loan officer, brand new. Good information for you to know. Okay, so grab a pencil, grab a backup pencil in case that first pencil breaks, and listen to this. 401k is set up by a corporation. The company says, "Hey, I want to help my employees. I have the ability to set up 401k. That is what's called qualified money. Means you haven't paid tax on it yet. And they get to set the TOW, terms of withdrawal. Terms of withdrawal inside of the 401k may say you can borrow $20,000 for a down payment. They may say you can withdraw for a down payment. So there's TOW that's set up within the corporation, and the way we find out is you tell me, hey, listen, I'm with this company and we got a 401k. I say, cool, who's the contact person? I email the contact person saying, hey, I'm a loan officer, I need terms of withdrawal. And they'll send me terms of withdrawal, and I'll get to know what they are. So there's one level of it. Here's another level. The IRS wants to know. Because the IRS has a provision in the code that allows you to take money out of the 401k for a house. For a house. Penalty free. Penalty free. Not tax free. Big difference. So penalty free, they allow a certain amount. Most of the time it's $11,000. Sometimes more, sometimes less. But penalty free. Above that amount, you must pay penalties. So there's a lot of math going on to find out. But if there's money in a 401k, usually you can't get more than 50% of it. So if somebody says, hey, I have $8,000 in my 401k mentally, as a loan officer, I go, if you've got $8,000, I could probably pull 4 out. That's usually the TOW on most 401ks, and that's just experience, whatever I've been doing it.
Jeanette, thank you for the love. Irene, thank you for the love. I slay all the time. Thank you for the love.
I slay.
And then said,
slay.
What is you made a large cash deposit and then applied for a mortgage? Pre-approval still to go?
I slay. I dig that. I slay.
All the time.
What if you made a large cash deposit and then applied for a mortgage? Pre-approval still go? Maybe. Most likely, yes, but maybe no. What? Okay, why? Here's why. Because let's just say you made a $10,000 cash deposit and you wanted to go put an offer on a house next week. Where did that $10,000 cash deposit come from? Oh, my mattress. The answer is no. I won a lawsuit and then I cashed the $10,000 check and then I put it back in my bank? Yes. It boils down to sourcing. Can I source those funds? If I cannot source the funds, then I need to season the funds. Season the funds means it must be in the bank for 60 days or longer.
Yep.
Source it, because cash deposits in and of themselves are not bad. But what the system is looking for is, are you a bad guy? Are you running drugs? Are you doing something illegal? Are you doing something wrong that we should be catching when cash deposits come in? If you sold a car and you say, hey, listen, I had a 1983 Buick that I sold for $10,000. Here is my bill of sale that I sent to the DMV. Here's the check that they gave me. I cashed it, put $10,000 in my hand, and then I decided to put it back into the bank. I can do that all day, every day. All day, every day, because I can source it. But if it's, trust me, bro, it's legal money, ain't going to never work. I need seasoning in the account. Now, if you had more than that in the account, and that's just ancillary money, it's not necessary for the down payment, then I just ignore it and everything else works going forward. So you can still buy, but there are some conditions.
Yeah, and I recommend get pre-approved anyway.
Yes.
So if we can't use the money, absolutely, because you wash cars on the weekends and you can't source it, get pre-qualified anyway. Know where you stand, because there may be challenges that you can be solving during this seasoning time. So there you go. Jordan G said, yeah, it was income, man. I was talking about income.
Okay, cool. Got it. Income. 188 J's.
Brother.
Is that crazy? Somebody makes 188. They make, how much you make? 186,000. We got all kinds of programs for you to help you, you poor guy that only makes $186,000 a year. Yeah, that's real. Yeah.
Miss Jasmine, I appreciate you guys. Thank you for your time and educational services.
We appreciate you too, Miss Jasmine. Thank you for showing up every day, touching the heart button. I know you do. I know you do. We're here for you.
DDL Crew Radio. Hi, is Feds dropping the rates at the next meeting or what?
DDL Crew.
I said or what. He didn't say or what.
All right, he said, oh, what?
That's me saying what?
DDL Crew. Things are not looking good, man. They're not looking good. They are not looking good. Everybody was hoping that the rates would come down. I do believe they're coming down, but Vegas says there's probably a 31% chance that it'll happen at the next meeting. That's what Vegas says. Vegas says there's a 70% chance it'll happen at the September meeting. That's what Vegas says. I believe no way in hell it happens at the next meeting. No way short of a cataclysmic event. What's a cataclysmic event?
My birthday.
Boom. Yeah.
Not my
That thing that happened, that, oh my God, because when that happened and the government started to go, this could destroy us. You know what they did? They said, hey, let's make a preemptive strike and drop the rates. And they did. They dropped them fast. They dropped them all the way down to 2%. And while everybody was going, oh my God, the whole world's going to die. The whole world's going to die. While everybody was doing that, the Fed, who they're pretty smart, by the way, these guys are not stupid. The Fed said, yeah, we're going to do a preemptive strike. We're going to drop the rates down. And guys like us started making money out of the freaking walls, man. We were like, I don't know how we got so many contracts in. Like, boom, doubled our business overnight. And I felt bad because everybody else was getting laid off, and we're just rolling in the dough. Well, we're paying for it now because loan officers are out of business all over the place because the Fed is keeping it high in order to correct what they did. Or I don't know if it's not really correct what they did. It's compensate for what they did, because I don't think what they did was necessarily bad. They got ahead of something that could have been very bad for us. Now we're just paying the price, man. It's like you ate a whole bunch of pizzas and Big Macs and all kinds of stuff, and now you got to hit the gym for a long time for you to get back to a healthy level. So do I think it's going to happen next Fed meeting? No, I don't. September, maybe. If they're going to fulfill their commitment of doing it, it's a commitment. They fulfill their forecast of dropping 3 times. They got to do it by October. But October turns into a weird thing because we got this big election going on where there's a sleepy guy and an orange guy that are going to be duking it out in the octagon. It's going to be pretty interesting.
And the guy that on Scream who makes the phone calls, hey, this is the guy from Scream. His name's RFK.
Oh, I like him.
Okay. Jordan Ruiz. This is a good question. It's going to take a minute to answer.
You go.
Should I pay my credit card balance down or pay my personal loan off? This is okay. So Jordan, pay attention to this because this is going to affect your credit score. Okay. So paying a credit card balance to 0 is going to boost your scores because the credit card has given you an opportunity to borrow money or not. Okay. So that is based on how much discipline you have. Okay. An installment loan is just a loan that a bank gave you that said if you make 50 payments, 48 payments, however many payments, it's going to go to 0. So there's not a whole lot of discipline in there other than the fact of making your payments on time. So depending on your goal, I don't know which debt to pay. But if we're talking about credit, if you're talking about just boosting your credit, then I would say pay the credit cards. If you're talking about getting the most purchase power, it depends on which one you're paying. Depends on which one has a higher monthly payment per month. Now, here's going to be my recommendation, okay? If you're looking to buy a house, let us pre-qualify you first because a lot of people throw a bunch of money at their debt, hoping it's going to help their credit, hoping it's going to boost their scores, hoping it's going to do an array of things, and they never get there because they paid the wrong things. For instance, charge-offs. Let's say you had a charge-off 5 years ago because you had a hard time or you were a dumb kid or whatever the circumstance may be, and you pay off that charge-off. Well, guess how much that helped you? None! It probably affects you negatively because now they're reporting and it's updated that you have something that you paid off from a long time ago that you were late on, and now your credit is worse. So here's my recommendation. Don't do anything to your credit. Talk to us first. We'll help you hit your goal, whether it's getting your rate, your scores up, higher purchase price, whatever that may be. We can do the calculations for you and make it happen. So I hope that helps, Jordan Ruiz.
Miss Jasmine says, get these guys some more likes. You're so smart, Miss Jasmine. We really appreciate you so much. We do. Thank you very much. Scold those people out there. We're giving you the raw data. We're dropping facts.
Kick facts. I slay all the time said the money was already there. Duh. Just took the money out and put it back.
Okay, so I slay all the time. If you just took it out and you put it back and it's the exact amount, I can usually make that work. Usually make it work. But if you said, hey, I only put 5,000 of the 10,000 back, it doesn't work anymore. It has to be the exact amount, and then we have to have a reason. Yeah, and the reason can be, I don't trust the banks, so I took cash out, but then I realized I have to put it back, so I put it back. That could be the real reason, and I can make that fly with an underwriter all day, every day. But if it's not the exact amount, you got problems.
Jordan Reese, thank you for the love. DDL crew. Crying, man. You made him cry.
Dude, I made you cry.
Drop the rates already.
I'm so sorry.
Drop the rates already.
I'm so sorry. Yeah, this guy right here. By the way, he's smart. And although it hurts our business a lot when the rates don't come down, I agree with what he's doing. I agree with it because we have to pay the piper for that time period when interest rates were ridiculously low. And these guys have a bigger responsibility to get the economy under control, and they can't just look at the housing industry. It's part of what they look at, but they have to look at big factors, not like unemployment is a factor, but it's not the only factor. It's probably the one in everybody's face. But housing affordability is a factor. Who's going to win the presidential election? That's a factor. What's going on in Russia? That's a factor. What's going on in Ukraine? All of these things, and it's not just this guy, by the way. There is a whole committee. They're called the FOMC, and I usually have a picture readily available right now. But it's the Fair Open Markets Committee, and that's the Federal Reserve. The Federal Reserve, I'll get a few later. They actually, here it is. Boom. That's the Federal Reserve. There's 12 very, very, very smart people that make this as a committee choice, and then this guy speaks. But he's not the only one who speaks. All the members of the Fed speak. They just speak at colleges or certain events or something like that, and they say their piece. And some of them say, I don't believe what these guys are doing is correct. And the way you know that is because this is actually the Fed funds. This is on the FOMC website, and these are all 12 members. And all 12 members are right now saying the interest rate, the Fed funds rate should be at 5.25 to 5.5. And see, all 12 members right here, they're about the same. But the next interest rate, some think it should be higher, some think it should be lower. And as time goes on, they come back to a consensus right around 2.5 in 2026, coming into 2027.
Yeah, DDL crew, but be real with me, man. Be real with me, and we'll be real with you.
Be real.
Why do you want rates to drop?
I want to make money. I want a Lambo.
Do you want to refinance? Do you want to buy a house?
I want a Lambo.
What's the reason you want rates to drop?
Lamborghini.
Okay, answer that question, and I'll give you some good direction.
Lamborghini, because I'll tell you what, when rates drop, you and I are going to get so many files, it's insane. We're going to have to hire more LOAs, loan officer assistants, probably hire a few more junior loan officers to help us with all our files, and then we're going to get a Lamborghini.
We are getting a Lamborghini?
I'm getting a Lamborghini.
Yeah, you're getting a Lamborghini, and I'll loan you money in 10 years.
Okay, good.
Catherine, I tried to get pre-approved, and they told me to wait regarding the cash deposit. That loan officer probably works for a bank that has very strict rules or regulations or something like that, and they probably have a line of people
they might be new.
that they want to pre-qualify.
They might be new.
Or they could be new, and they could be not at the level of understanding that you can do these things. So here's the case. We fight for every single loan.
We have
fight
to
get them.
We have to.
We fight to keep them.
Yeah.
We fight to fund them.
Yes.
So if you want to work with someone that fights for you, give us a call.
Just funded one 10 minutes before we walked into this loan.
That was a fight.
That was a fight. It was a big fight. Yeah. So yeah, there's a lot of things. And by the way, if you're a new loan officer, nothing against you. This is a very difficult business. You need a good mentor. You need a great mentor.
That's a big deal.
A great mentor, or else you'll be statistics. Statistically, 85% of loan officers fail in this business.
Statistically, 60% of marriages end in divorce.
Damn, that's crazy.
Jordan Ruiz back in the house. I'm trying to get a higher purchase price.
I want you to get one, Jordan. I want you to get a higher purchase price.
Okay, so you need to call us then, man, because we're going to have to put your file together, see what your debt-to-income ratio is, and guide you down the path of getting there. So easy peasy, lemon squeezy. I'm going to give you 3 seconds to screenshot this, and that's it. Catherine's back.
That's pretty impressive.
That was the reason not trusting the bank, an exact amount put back.
Then you should, if you have a good loan officer, by the way, because not all loan officers are courageous enough to talk to the underwriters, because
sissies.
Yeah, the underwriter's gonna go, wait a minute, we got a large cash deposit. They're like, I took it out, put it back. You're like, yeah, we can't do that. And then I'm gonna get an LOE, which is called letter of explanation, and they're gonna say, why did you take it out and put it back? And you're gonna be honest. You're gonna say, I didn't trust the bank, but since I needed it for a house, I put it back. And although it sounds wrong, the underwriter will be like, all right, I believe that. Cool. And we'll get it funded. Yeah.
Yeah.
Yeah,
Nice. Do you guys help people in New York, New Jersey, and Connecticut?
Oh, by 3 of them? Oh my God, we're here to
She
help
don't know
you.
where she wants to live, man.
Hey, Catherine Sidol. By the way, there's a best Go player in the world named Lee Sedol. That same last name. Lee Sedol. Anyway, Catherine. Yes, all 50 states. All 50. Here's a quiz for you, Catherine. How many states are there in the union? Here's a hint. We do loans in all 50 of them. You do the math from here on down. Yes, we will do your loan. New York, New Jersey, Connecticut. And yes, I said New York. Most banks don't do New York. You're either in New York or not in New York. We are one of the rare banks that does New York.
Rare. Credit was just ran with the bank. How long do I have to wait until it is considered one hit on my credit to shop around?
You talk.
All right, let's talk about credit. Okay, credit. So, credit is based on discipline, guys. Only discipline. Are you disciplined enough to not have a bunch of people pull your credit? Are you disciplined enough to not go to Kohl's and save 20%, Home Depot and save 20%? See if you can get this credit card. See if you can get this Apple Pay. See if you can get all these things, okay? Because it's exciting when you're first getting credit. It's exciting to see what people will let you borrow. It's exciting to see if you can get that car, okay? That's kid stuff. Let's act like adults now, okay?
I hate that part.
I know. Don't grow up. It's a trap.
I hate
It's a
that
trap.
part.
Peter Pan and Michael Jackson had it right.
I hate that. Wait, that got weird.
It depends on what you're thinking of,
I
man.
don't know what you're thinking
I'm
of
thinking
either,
of a
man.
guy who lived his life like
I don't know, man.
Peter.
Yeah.
All right, maybe that's a bad song. Anyway, so here's the case. If you pulled your credit a lot of times in the last 6 months, yeah, there's no discipline. You'll have a lower score. But if you pulled your score once because you applied for a mortgage and then you pull it again with us, your credit's going to be fine as long as you've made your payments on time, as long as you've kept your credit card balances down, and as long as you're being disciplined. So that being said, if you've only went to go get your credit pulled once, maybe twice in the last 6 months, and we pull it again, you're going to be fine. But if you know you haven't been disciplined, if you know you haven't been making payments on time, if you know your credit card balances are higher because you went on a shopping spree, then yeah, it's going to be a little lower. But that's not going to stop you from buying a house. And as long as that discipline kicks back in and you've had good history in the past, your scores are going to go back up. So there's no harm, no foul. Don't worry about your credit. If you have crap credit, you know it. If you have good credit, you know it. And if you do have crap credit and you want to get it fixed, go to the link in the bio, click on Fix My Credit.
What? Yeah.
So what else, man? What else is going on?
So, by the way, there's another thing to shop around. Catherine Sedol. Catherine, if you had a mortgage loan officer pull your credit, the system knows that you might shop for a better rate. So, within a certain period of time, between 2 and 4 weeks, depending on who you're listening to, if you have another one or two pull your credit, probably won't affect it. Probably won't. If you go overboard and you start having 5, 6, 7, 8, 9, 10, at that point it will start to affect it dramatically. But 2, 3, probably not going to affect it. So that's very important. The system knows that you might be shopping for a better rate, so there's this weird period and nobody really lands on it. They won't tell you exactly what it is. Between 2 and 4 weeks is kind of the number. What do you think about that?
I just said that.
Okay.
I already shared that with Catherine Sedol, Lee Sedol's brother, sister, cousin, whatever. Okay, so let's talk about a couple. Well, hold on. I'll be reaching out to you guys ASAP. Okay, 2 ways to do that, Catherine. Tell her the 2 ways, Lee.
You can use ESP and call us right now and talk
3
into
ways
his brain.
to contact us. 3 ways.
Talking to his brain from ESP right now, and don't let the evil spirits get in between you and him. All right, cool. Or you can call the number on your screen right here as soon as we're done with the live. We're going to be done in not that long. We don't have much longer. We go live for about an hour. So you could call Chris as soon as we finish this live. We will literally answer the phone. We will literally start your file right then, answer all your questions, and get moving forward. And get you on the road to purchasing your house. The third way, go to the link at the top of our bio, fill out the application, upload the documents. We'll get a notification as soon as all the documents are uploaded, and then we'll start your file. Call us to let us know you did it. That's a very important part.
Okay, I asked DDL a question, DDL crew up top. I asked him, why do you want rates to go down? I was trying to figure out his reasoning. If it was refinancing, we can kind of guide him. If it was purchasing,
I said Lamborghini.
He said Lamborghini. But let me share something with you guys who are on the fence about buying a house. You're like, I know there's a group of you who are watching the news, listening to their uncle who bought a house once or was in a house once, I don't know, and says it's the bad time to buy because interest rates are high. Okay, let me give you a little bit of history, and I'll give you a projection moving forward. Okay. So, history, 2020, 2021. Only a few years ago, guys, what happened is we had that big pandemic thingy that happened. Rates went down, value skyrocketed. Value skyrocketed because everyone saw an opportunity to borrow cheap money. They maybe thought it was easier to qualify. I don't know, because it's not easier to qualify. Just if you qualify, you qualify. If you don't, you don't. But it infused a bunch of buyers. Now, when rates went up, values stopped. Okay, so across the country, you have a tiny little gradual increase, and they are going up in certain pocket communities. They are going down in certain pocket communities, but for the most part, values are pretty much holding. So if you're shopping for a house right now, you're not trying to get in and scramble because everything's pretty much holding. Now, what Lee said is based on this chart, the bottom of rates is in about 3 years, okay? 3 years, which means you have about 6 months until the ball gets rolling with the market of the interest rate drops. So if our first one is in September, I don't think it's going to be gangbusters. I think it's going to be gangbusters when it actually changes a point. And that's probably not going to be until next year. So what does that mean to you? It means you can buy at relatively low prices. Now, low is relatively speaking, of course, but low prices and participate in that equity gain when the rates come down. So remember 2020, 2021, rates go down, values skyrocket. So if you get in now, you have an opportunity to, 1, buy a house at its cheapest, 2, have some equity gain inside of that property in a very small window, 2 to 3 years, okay? And I'm not talking about making 10 grand here, 20 grand there. I'm talking about making $100,000, $200,000, maybe even $300,000 on a single property, okay? Now, if this isn't your dream home, guess what you do in 3 years? You take that $100,000 to $300,000 in equity and apply it to your dream home or your goals, whatever you're trying to accomplish. And if you choose to at that time not take any money, guess what you get to do? Take your high rate and that extremely high value now, refinance it, bottom out that mortgage payment, and coast it out for the next 30 years at a 2, 3, 4% interest rate, depending on how low it goes. Now,
that sounds perfect.
If you look at the chart, we're going to hit the 2s. We're going to be in the 2s if you look at this chart that the federal government has put out. We didn't create it. Yeah. The federal government did. So how does that sound to you guys? And what do you think, Lee? What do you think about that?
What I think about that is the most important thing you need to remember. We've been Chris and Lee. We're out.